Hi, it's Dak Hartsock. For those of you that know me, you might not be surprised to know one of my clients bet me I could not get this video done in less than 5 minutes. So if I seem to speed up a little bit or maybe speak a little quickly, it's because I don't want to lose that bet. And of course, I also want to be respectful of your time and interest. So let's hop right into this. What we're doing today is a quick, hopefully less than 5 minutes, performance report on the market income portfolio for the month of May and also year-to-date 2015 through the end of May. And very quickly, I want to go back for those of you who aren't clear on this. Process portfolios is basically all the strategies that we put to work for our client accounts. And it used to be each one of these strategies, or the ones that were applicable to a given client, was at work within a single account. And what we figured out and what we've been working on for coming up on a year now is getting these things split apart into separate portfolio accounts so that there's greater transparency, greater visibility for both our clients and ourselves, so that everybody has a better idea of what's happening in a given portfolio, what it's doing, where the risks are, what we're trying to do with it, and what we think we can do with it. And doing this by splitting it into the process portfolios really gives me, as the portfolio manager, a lot more visibility into what's working and a lot more clear understanding of changes that need to be made, after a certain point in time. It helps me pinpoint these. So this is a positive for everyone. And I think you're going to enjoy it too, because we're going to release, one or two of these a month or maybe every quarter, so that you're always getting some understanding of what's happening, what we're trying to do, how it's working, what's not working, and what we think we're going to do about it. So at any rate, let's move on because I'm already almost 2 minutes. Quick summary for those that maybe don't recall exactly what market income does. Basically, it invests in a basket of securities, and what we do is we sell off the atypical return for a premium. And what that means in English is, in any given month, one of the securities we buy statistically is only going to return a certain amount. Now, there's months where it's going to do a lot more than that. There's months where it's going to do a lot less than that. There's months where it's going to do nothing. But what we do is we take advantage of that by selling off anything that's above the average return. And what we do when we do that is collect a premium. And an easy way to think about that is kind of collecting a synthetic dividend, if you will. And some months we get some of that dividend. Most months we get all of it. Dividend is not the right word, but that premium, we get some of it. Some months we get all of it, some months. But basically every single month we're getting some kind of piece, some kind of reward over and above just owning the security. And that's nice because it's really a bird in hand strategy that seeks consistent returns with lower market risk. And I'm going to move ahead now, but you guys can come back and hit pause on this video if you want to read a little more about it, or obviously call and email me with any questions. So here we have the month of May, and as you can see, this green line here, if you follow my mouse pointer, that's the S&P, and it's banging around a lot. It's it's down, it's up, it's down, it's up, it's up, it's down. Pretty sharp movements. And we look at the blue line, that is market income, and we can see it's pretty much doing what it's designed to do, which is just kind of take an average return and add a little bit to it, but just plod along, moving up consistently without these big moves down in particular. The up is going to come over time. It's the big moves down we really want to avoid, and just let it work, let time work for us, and take those gains as they come rather than trying to chase the market. And what we saw here in May is that market income did okay, lagged the S&P by a little bit, but not bad considering you're not getting all of this up and down. So if we look at the risk comparisons, we'll make this very brief because this is really portfolio manager stuff that most people don't care about. But the drawdown is kind of important. And what this means is during the month, the S&P dropped 1.55% at one point. And during the month, the market income dropped about a third of that. And then if we look at some of these other things, Sharpe ratio here, right, that's risk efficiency. We can see that, and the higher that number is, the more risk efficient the portfolio is. So market income is about 77% more risk efficient in the month of May than the S&P. Standard deviation, which is here, is how you measure pure risk. And again, we see that the market income portfolio taking about 63% less risk. Downside deviation, this is how much it falls in terms of deviations. And again, we're seeing the market income is really not taking a big participation, or not having big participation in the downside activity, which is ideal. That's what we're looking for. Probability of loss, Sortino ratio, and this is a big one. It's important. The higher this number is, again, the better off you're doing. Oh, darn, I just went over my 5 minutes. Well, we'll wrap this up very, very quickly, less than a minute. So at any rate, the higher this is, the lower your rate of loss. And as we can see here again, doing quite a bit better than the S&P, about a third. If we look at January through May, so year to date, what you see is the market income portfolio. Here's the blue line, here's the green line with the S&P. And the reason earlier on that you're seeing this is we moved for this portfolio all the money from client accounts into it in basically November and December, and then we had to reestablish all the positions now in the market income portfolio rather than in all the client accounts. So it takes a couple of months, to catch up and stabilize and begin working. But then you see, you get some of the upside participation, that we talk about, but you're also seeing less volatility. It's not moving up and down as much, and it's kind of just creeping upward. And you can see over the period, it's outperformed the S&P by a significant margin. If you look at this as a percentage basis, versus the S&P, it's very nice return versus what you could have gotten. Now, quick risk metrics. Again, you're seeing some significant differences. You guys can read these things at the bottom or look at them in the video. There's really one thing I want to point out, and this again reinforces the risk efficiency of this portfolio, is the recovery here, right? When the SPY sold, SPY is the S&P, when this thing sold off, it took about 31 days to get back to break even. In the market income, same situation, had a big sell-off, took about 7 days to fully recover. That's a massive difference in performance, and it's something that I think we're going to continue to see over the months and years ahead of us as we manage your money in this portfolio. So at any rate, 7.5 minutes, far too long, but I need to get this up. Next time it'll be faster because everyone's going to be used to seeing some of these things. So there you have it. Questions, call, email. Hope everybody had a great Father's Day, and I'll talk to you soon.